Good, let's do Q Traders. Q Traders uses a periodic inventory system for their financial year ends on 28 February 2013. Always a very important date, so please mark that. Also important, a periodic inventory system. Why is that important? Guys, in this question, what do they want us to do? They want you to do the journal entries for all those different items there, 1 to 6. Journal narrations are not required. Assume that all parties are registered VAT vendors and amounts include VAT where applicable. Now, why is it important that we note that it is a periodic inventory system? It is important because sales transactions will only be the sales transaction, and the inventory and cost of sales entry will not take place with the sales transaction. Why not? Because cost of sales in a periodic inventory system is basically a calculation. Opening inventory is transferred to the cost of sales account. All the purchases and purchase-related accounts, which are all separate in the journal, are balanced off, and the balances are transferred to the cost of sales account. And then the closing inventory is inserted in the inventory account at the end of the period, and the counter leg goes to the cost of sales account. So cost of sales then will consist out of the balances of opening inventory plus purchases plus the balances of all purchase-related costs like transport costs, freight charges, etc., less the balance of our closing inventory. So that means when we're going to have a sales transaction, it will only be the sales transaction that will be recorded in our books. There's no adjustment for the inventory records. The entity has a VAT control account with a credit balance as at 31 January 2013 of 51,800 rand. Credit balance means that Q Traders owes the receiver of revenue 51,800 rand for VAT. The current VAT rate is 14%. Now, if you can't read, I cannot help you. If you did work on 15%, please open your eyes. And if you're going to make this mistake in a test or exam, the rest of your question is going to be marked incorrect and all your calculations are going to be wrong. So you're going to earn yourself a nice cool round 0 for your question. The following transactions occurred in February, and remember they want us to do the journal. Goods with a list price of 433,200 rand. What is a list price? Does a list price include that? Yes, it does. That was sold to a, now list price is a normal price. That is the price that is actually inserted in our records. It is on our computer. If we want to make any inquiry of what is the cost of the selling cost of a certain item, I go into the computer and the computer will give me this amount of 433,200, so that will include that. Now it is sold to JB Stores on credit, so it's a debtor. Q Traders granted a trade discount of 5% on the list price to the customer. So did the customer pay 433,200 rand? Did the invoice that I issued, was that for an amount of 433,200? No, guys, it is not. So it is the policy of Q Traders to allow an additional discount of 2% to customers if they settle their accounts within 30 days. So in this first mark here, this point here, we already identified a trade discount. Now we see that there's also a settlement discount of 2% should the JB Stores settle their outstanding bill within 30 days. JB Stores always make use of the discount by settling their account in time, and Q Traders expects that JB Stores will continue to utilize this discount. So what is the question that you ask yourself? The question that you ask yourself is, was there an expectation when the sales transaction took place whether JB Stores will utilize the settlement discount or not? And the answer is clearly yes. We have expected them that they're going to make use of that discount. Now, if the expectation exists, I'm going to make an allowance for settlement discount upfront, i.e. with a sales transaction. So what is the process that we have to follow? The first step always is determine the invoice price. the invoice price is not 433,200 Rand. The invoice price is 95% of 43,200. So if I take the 433,200 times 95%, it gives me an invoice price of 411,540. Now that invoice price inclusive of VAT. If I take out the VAT exclusive amount is 361,000. Now, I always have students come and ask me, must we take out the VAT first and then multiply it by 95%? Or must we multiply it by 95% first and then take out the VAT? Guys, it does not matter. Look here, I've done both in order to prove to you that it does not matter. In this example here, I multiplied it with 95% first and then I took out the VAT. In this example here, I took out the VAT first and that gave me 380,000. Then I multiplied 380,000 times 95%, that gives me 361,000. But I've already excluded the VAT, so the 361,000 is the VAT exclusive amount. Here we multiplied straight away with the 95% and then we took out the VAT and we end up with the same 361,000. So can you see, it doesn't matter whether I take out the VAT first and then multiply that, or multiply it first and then take out the VAT, I end up with the same VAT exclusive amount of 361,000. What is the next step? I've got now the invoice price. I took out the VAT, so I know exactly what is the VAT. What is the VAT? The 411,540 less the 361, or the 361 times 14%, which is 50,540. So I know the invoice price, I took out the VAT. I determined the VAT exclusive price, there was it, 361,000. And now I have to break down the VAT exclusive price into its two legs. The one leg, i.e. 98%. Why 98%? Because they grant a settlement discount of 2%. So therefore 98% of the VAT exclusive amount, that I'm going to take to my sales. And the 2%, the expected settlement discount, I'm going to take to an allowance for settlement discount account. So I'm going to debit my debtors control with what? What does the debtor owe me? The debtor owes me the invoice price. So the invoice price is the 411,540. And that is what I'm going to take to the debtor. The VAT inclusive listed price times 95%. That we've determined would be the full invoice price. Then, 98% of the VAT exclusive amount will go to sales. So here is our sales amount, 98% of the VAT exclusive amount, 353,780. And 2% of the VAT exclusive amount will go to our allowance for settlement discount. Allowance for settlement discount, 7,220. The VAT that appeared on the invoice, i.e. the 361,000 times 14%, the 50,540, that will then go to my VAT output account. Number 2, goods were purchased for 256,500 Rand and paid for by cheque. Remember, we have a periodic inventory system. So, because we have a periodic inventory system, we are not going to debit inventory. If you did debit inventory, you wouldn't have received one single mark for your attempt. So this amount, 256,500, at the end of the story, they say, assume that all parties are registered VAT vendors and that all amounts include VAT where applicable. So obviously that is an amount that will include VAT. Purchases. An expense account will be debited with a VAT exclusive amount of 225,000. VAT input is going to be debited with a VAT included in the 256,500, 31,500, and then bank will be credited with a total amount of 256,500, the amount of the purchase. Don't forget your statement indication, purchases, statement of profit or loss, VAT input, statement of financial position, and bank statement of financial position. The entity's bank statement indicated the following: bank charges 171 Rand and interest on the overdraft 325 Rand. Remember, interest is not subject to VAT, but bank charges is subject to VAT, so I have to take out the VAT there with the 171 Rand. So I'm going to debit our interest expense, the interest on the overdraft, that the full 325 will go to my expense account. So the full 325 will go to my interest expense account in the statement of profit or loss. Bank charges is going to be the VAT exclusive portion of the 171, which is 150 Rand, and VAT input is going to be 150 times 14%, which is 21 Rand. The total amount that went through our bank account will then be the 496. If I add 171 with the 325, it gives me 496, and that went through on my bank statement, and it must be reflected as such in my own accounts. So therefore, my bank would be credited with 496, interest the full amount, and then bank charges is split between the cost and the VAT amount applicable on that. Number 4. Issue a check to settle the VAT due at the beginning of the month. Well, this is still an old question, so you can replace that with issue an electronic funds transfer for the amount outstanding at the beginning of the month. Same story. Good, so they had a credit balance of 51,800. I'm going to pay them, so I'm going to debit my VAT control account, statement of financial position, 51,800. I'm going to credit my bank account, statement of financial position, 51,800. Oops, sorry. Then number 5, receive a letter from the South African Revenue Services that states that the last VAT payment, i.e. that 51,800, was received late and that a fine of 10% on the amount have been levied. So they've only levied this fine. We haven't paid the fine as yet, but we must recognize the commitment to pay the fine. So we're going to debit an expense account penalty, statement of profit or loss, 51,800 times 10% equals 5180, and we're going to credit the VAT control account in the statement of financial position with 5180. Next time when we're going to settle our outstanding VAT, we're going to credit bank and debit the VAT control account. Then that will be out of our books as well. Then transaction number 6, the allowance for credit losses had a zero balance as at 31 January 2013. When was that? At the end of the last financial year. The account of one of the entity's debtors, F. van der Berg, has been overdue for 6 months. The management of Q Traders is uncertain as to whether he will settle his account since the normal credit period is 30 days. However, Q Traders will continue to send monthly statements to this debtor in an attempt to collect the outstanding amount of 57,000 Rand. So by reading that paragraph, are we going to write off the debt? Guys, if we're going to write off the debt, then there won't be any monthly statements to send to him because according to our records, his balance would be zero. So therefore, we're not going to write off his debt, but we're rather going to create an allowance for credit losses. There's also no certainty that he's not going to repay us. We just have this gut feel that we're never going to collect that money. So therefore, we do not want to remove it from the radar screen. We only want to make sure that we are going to show our outstanding trade receivables at a reasonable amount in our statement of financial position. Now that allowance for credit losses is going to be based on this outstanding amount of this debtor of Van den Berg. The outstanding amount is 57,000. Now, if we're going to take the 57,000, that will include VAT. What will be the loss that we're eventually going to encounter should this guy not pay his account? We are not going to encounter out of our own pocket a full 57,000 Rand worth of loss. We are going to encounter the VAT exclusive portion of 57,000, i.e. 50,000 Rand. So when we're going to create that allowance for credit losses, we're going to take out the VAT portion because the receiver of revenue we will recover that amount from him. So therefore, we're going to debit an expense account, credit losses. You can also debit here an adjustment for credit losses allowance account if you want to, but it's still an expense account in the statement of profit or loss of 50,000 Rand, the VAT exclusive portion, and we're going to credit an allowance for credit losses of 50,000. How do we disclose this allowance for credit losses in our financial statements at the end of the year? In our trade and other receivables note, we're going to have gross debtors with whatever the balance is, and then we're going to say less allowance for credit losses, 50,000, less allowance for settlement discount. Here we have an allowance for settlement discount of 7,220, and that will then bring us to the final trade receivables amount, and that final amount will appear on the face of the statement of financial position as the outstanding debtors amount.